In this video, I'm going to talk to you about some crazy investing facts. Some of these can make a positive difference in your portfolio. And of course, by the end of this video, you'll have a better idea of where to invest and gain some really cool investing knowledge. One of the biggest myths I hear all the time is that you have to get a financial advisor, especially if you have a lot of money. And this is not true at all. I can actually prove it. 92% of financial advisors have underperformed against the S&P 500. What that means is that in the course of many years, financial advisors underperform and they charge fees. That means that if you invest in the Vanguard S&P 500 and you leave it there and you don't have to worry about anything and it's one thing you have to buy, you will beat most financial advisors. So what this means, and this is crazy, is that if you just invest in VU, you won't have to worry about hiring a financial advisor and you'll be doing better than almost all of them. If an ETF like VU outperforming most professionals isn't shocking enough, monkeys throwing darts at a board have also way outperformed most of the best investors in the world. The reason for this is you can never really know which stocks are going to do well. Even when you do research, all you can predict is how likely a company is to do well in the future. However, oftentimes this isn't correct and has a lot of missing information, and so it's very hard to actually predict what will do well and what won't. And so because of that, when monkeys chose random stocks on a board using darts, they outperformed some of the best investors on the planet. What this tells you is that trying to predict the market, trying to day trade may work for you in the temporary, but in the long run, you're going to end up losing your money. It's incredibly difficult to predict, and if you want solid, great returns, you just need to invest in an ETF like VU, and you won't have any problems. It's pretty crazy that monkeys can outperform some of the best investors. They're professionals at their own game. One thing you may not have realized is that you pay a lot more taxes if you hold your stocks for less time. For example, if you hold your stocks for a year or longer, meaning long-term investing, you will pay a long-term capital gains tax. This means that when you sell that stock, you pay a much smaller amount of tax than if you had held it for less than a year. Whereas if you hold it for less than a year, you pay a short-term capital gains tax, which means that you are taxed at a much higher amount. This is to encourage long-term investing, so don't day trade because not only is it more risky, but of course you're going to end up losing a lot of money on that short-term capital gains tax. Not worth it at all. Hey, make sure you go down below and click that subscribe button. It only takes 1 second and you can always change your mind later. If you have any stocks right now that are losing you a lot of money and you don't believe in them in the long run and you want to get rid of them, you can sell those stocks and then use that on your tax form. It's called tax loss harvesting. What it means is that you sell stocks at a loss and you use those to offset your gains and pay less taxes. So basically you lose $1,000 in the market, you use that $1,000 loss on your taxes to pay less taxes on whatever money you've made. This is a really cool trick and a lot of professionals use it. Some programs even use it automatically so you don't even have to worry about it, but it's something you should know about because if you have any stocks, you made any mistakes, you bought something you regret buying and you don't think it's going to do well in the long run, use it to pay less taxes. Hey, thank you so much for watching this far. You don't know how much I appreciate it. That is it for today. Have an incredible day, and if you have any questions, be sure to ask down below.